Welcome everybody to the latest edition of Do More With Your Money. It's a May question and answer special. So we've got a host of experts here today. We have Kevin Kidney, Head of Asset Allocation, Sophie Bennett, Client Service and Supervisor, and John Mason, Head of Monitoring and Control. Welcome to you all. Before we start the question and answers, we want to show off a little bit. We want to show our latest awards off, which we won at the Wealth and Assets Management Award, Technology Firm of the Year, Marketing Campaign of the Year, and also Wealth Tech Firm of the Year 2024. So thanks to everybody that supported us, especially you, the viewer, and you, the client. Something that we're proud of at True Potential, and hopefully we're going to win some more. So, got a bit of a packed schedule today. We want to go through some questions and answers. The questions were posed by yourself, the viewer, and the client in most cases. So we're going to obviously have a look at the questions. I'm probably going to give them to whoever on the panel. Hopefully I might be able to answer some myself. But the first question is, how much can I contribute to my ISA pension in the new tax year? Sophie?
Yeah. So they're both two separate allowances, so I'll just start off with your ISA allowance. So if you are looking to contribute to an ISA this tax year, the current allowance is £20,000 per tax year. Unless you're looking at a junior ISA, if you're under the age of 18, in which case the allowance there is £9,000 a tax year. So that one's pretty simple and straightforward. The pension one, that's a little bit more tricky. It is straightforward, but it can depend on your earnings as well. So for this 2024 to 25 tax year, the allowance is £60,000 or, your highest earnings, whichever is higher. So that can all go into your pension. That includes any contributions from yourself, your employer, your tax relief, all has to be included in that £60,000. Or, if you learn less than that, it's your highest earnings.
Yeah, so if you earned 40,000 as an example, you can only put 40,000 in.
That's right.
Whereas if you earned 80,000, you can only put the 60,000 limit in.
Absolutely.
Okay. And if you're unsure on that, I would say contact us and speak to one of the financial advisors who can help you out. So probably one for, again, you, Sophie, and probably maybe it's for you, John, as well. What's the taxation of pension income in general?
So in terms of pension income, when you start to take money out of your pension, there's a portion of most pensions that will be completely tax-free. It's usually a quarter of your pension is your tax-free cash amount, and then the other 3/4 of your pension, you'll usually pay income tax on that, or it will at least be put through payroll to see if you need to pay income tax on it. So when you come to retire, let's assume you haven't touched your pension at all. You've got your full 25% tax-free cash availability. That's not to say you need to take the whole 25% out as a lump sum. Many pensions are much more flexible than that, particularly since the pension reforms came in around 2015, 2016. So what we tend to find is individuals might want to take a portion of their tax-free cash out each month if they want to pay themselves a monthly amount from their pension. Some of it could be from their tax-free cash. Some of it could be from their taxable part of their pension.
Yeah.
And generally speaking, it's the same tax rates that you would pay on earned income. So you've got your personal allowance, just over £12,500. That's how much you're allowed to take in taxable income without actually having to pay tax. Above that, you start to get into the 20% rate for English taxpayers, then the 40% rate and the 45% rate. Now, those differ depending on which country in the UK you're listening from or watching from. Tax rates in Scotland are a little bit more nuanced. There's a few more staggered steps for those individuals, but it follows much the same rules as your standard income.
Yeah, and it's a really important point what you said there, John, about it being your total income, because you might have income coming from your pension, but then you might have state pension coming in, and you could have maybe all sorts of other income, that sort of stuff. So it's wise to check, I would say, if you're not sure on how much you are potentially going to get taxed, is to check. Give us a call, and one of the financial advisors will review that for you. Okay, great. So moving more from the advice side, probably onto maybe more the investment environment. How do interest rates affect me, and when will they come down? That's a very expansive question. Over to you, Kevin.
It is. So I'll finish with the outlook for interest rates. So how do interest rates affect me? So if you are a homeowner, and if the Bank of England are right, then 2024 is going to see the most impact upon mortgage holders, this is a year where the rise in interest rates over the last 2 years will bite the most.
Yeah.
It's probably been one of the most profound changes in interest rates since the Second World War. We've gone from rates near zero and mortgage rates somewhere between 1% to 2%, to mortgage rates somewhere between 4% to 6%. And that does have an impact upon people's monthly incomes. So the rise in interest rates certainly affects the liability side, people who have to pay a liability monthly, and that's obviously compounded with the cost of living pressures as well. On the asset side, well, it's good for savers. It's good for those who are invested with true potential portfolios in terms of the yield or income they can get from corporate and government bonds. And what does it mean for the outlook for interest rates? Well, we're already seeing interest rates being lowered in what I'll describe as sort of peripheral Europe. So yesterday, the Swedish Central Bank lowered interest rates. We've seen interest rate cuts in Eastern Europe in the spring. We're likely to see a modest decrease in interest rates in the Eurozone, possibly as early as next month. The Bank of England are probably not going to be that far behind, but the decrease in interest rates will be very, very modest. So if we have the official base rate right now is about 5.25%. It's possible that could be as low as 4.75% through the autumn, but we're not going to see a return to the interest rates we saw pre-COVID. And the real reason for that is, I know a lot of people don't feel it, but the overall growth picture globally is a lot stronger, and there are still some inflation pressures in the economy. So even though we might see inflation fall quite a lot this quarter, and inflation might actually get below 2%, it may be brief, because there are parts of the economy in the UK, particularly the services-based economy, which are still passing through price pressures of somewhere between 4% to 6%. So we're definitely past the peak in interest rates in the UK. There's room for some lower interest rates from the Bank of England in the spring and through the summer, but it's likely to be modest.
And I suppose like you said, Kevin, we've had years and years of low interest rates, and it's come with a bit of a shock to people, isn't it? Because if you look at your average mortgage rate, it's, people think that's excessively high, but in the grand scheme of things, we've had it really, really low.
Yes, I think if you take the period 2008 through 2021, immediately prior to 2008, interest rates were between 5% to 6%.
Yep.
In the 90s, they were somewhere between 7% to 8%. So what the 2010-2020 period was highly unusual. It was a global phenomenon. It was the result of a global financial crisis and a very low inflation print. But such have been the consequences of COVID and government spending that the reset in interest rates is much higher, and we're not really going to return to those levels.
I know you're saying probably even still it's going to be a more of a gradual decrease in those rates. So
yes, and I think central banks who control these interest rates obviously are going to be really cautious in lowering interest rates, very measured, because they got their fingers burnt with allowing inflation to rise too high too quickly through 2021, and we're probably too late in addressing that. And then there are measures that are beyond our control. The conflict in Ukraine and Russia and the impact that had not just on energy prices but on food prices, those are beginning to unwind in terms of inflation, but they're not beginning to unwind in terms of really prices aren't coming down. So I think we'll see gradually lower interest rates, but if we're starting at something like 5.25 today, maybe a reasonable outcome over the next 9 months or so is something around 4.5%.
Yeah, and our regular viewers will have seen the difficulties we've had from not just a growth point of view, but over the last couple of years. Looking more positive now, would you say?
Yes, I think particularly in the UK, believe it or not, I think if the data points we look at for the UK are flashing the most greens. It's worth adding that the UK probably has the lowest starting point. We had no growth at the end of last year.
Yep.
We're looking at some firming growth in Q1. We get GDP data tomorrow, which likely confirms that we had a very strong or relatively strong quarter. But we're seeing a number of indicators in the corporate side, so in the stock market, which are flashing green. Things like margins are expanding, so corporates are increasing profitability. We're seeing earnings beginning to be revised up, not down. And we're seeing just a momentum in those earnings being revised higher. So the UK stock market has lagged the global indices for much of 2023 and through the first few months of this year, but it's beginning to catch up, and that's reflecting an upswing in growth here.
I looked at my portfolios over the last couple of days and noticed, it had made a massive shift up, which was really, really positive. So, we've had discussions with clients about remaining invested in the goals behind those and long-term goals and how the market works. So all positive moving forward. Okay, great. So next question. I think I'll pass this one over to you, John. Question in from a client. I am retired. How much income is safe or sensible to take?
Yeah, so it's quite, again, a question that the answer can vary depending on the position of the person who's asking it. So it's difficult to speak in a sort of generic sense, but in terms of how much income is safe to take out of an investment, you'll get figures bandied about as to what a safe withdrawal rate is. A lot of the time we tend to fall somewhere around the 4% a year mark. The idea behind that is if you're taking money out of an investment at a rate of, say, 4% a year, the hope or the expectation is that because the underlying fund stays invested, the growth that you'll get annually will hope to replace at least some, if not all, of those withdrawals that you're taking. Now, obviously, as your withdrawals potentially increase over time with inflation, you might want to take more out year on year. It's always worth monitoring your investment and your portfolio on an ongoing basis to make sure that those withdrawals you're taking are sustainable and you haven't whittled your fund down too much. But
and what we mean by sustainable is obviously, John, is that if you're taking too much of a percentage out of your pension might not last you until you're not here anymore. And the 4% would be something that we use as a guideline, but what you're saying is it doesn't apply to everybody.
No, of course not. I mean, if you've got someone who's 55 years old and have decided to take early retirement, they're taking 5, 6, 7% a year out of their investment or out of their pension. Your average life expectancy for someone of that age is in the 80s. There's a question mark over whether you're going to be able to sustain that for the full 30 years of retirement. Exactly, it could run out if you take from it too quickly. Equally, it's not uncommon to live beyond average life expectancy, 90s. Some people live past to the age of 100. So when we talk about a sustainable withdrawal rate, we want to put individuals in a position where, regardless of how long they live, they've got a good chance of that fund lasting them and not running out before they still need it.
Yeah, and I had a question myself from a client of a recent podcast, and they were questioning whether or not the 4% is correct. But to be fair, 4% is a guideline. It's something that we work on, and it's not really applicable to everybody, is it?
No, it can vary, and it can be a different scenario depending on a lot of things. Like I say, your age, 4% a year starting at age 55 is a very different proposition to 4% a year starting at age 80, for example. You've got a lot of time when you're age 55 to make that pension or that investment last. The level of risk you're taking can affect it as well. So if you've got a portfolio that's only expected to grow by 2-3% a year, naturally your withdrawals are going to whittle it down more quickly. If you've got a portfolio that's in a position to grow by 5, 6, 7% a year at times, then you potentially replace those withdrawals.
Yeah, it's a good point. It's the level of risk that you take and whether or not you're comfortable taking that risk. But also you've got other income potentially coming in. You might want to take above the 4% for a couple of years because you're getting your state pension in 2 years, and then you might want to reduce it back. So it's always worth, I would say, having a review with an advisor, which will have a look at your total income, your personal circumstances. You may have a partner whose state pension is coming in. You may have a partner whose personal pension is coming in and is not yet retired. So it's always worth to have a look at that as a financial advisor and have a look at your own personal circumstances if you're worried about that. So okay, great points. Great. Okay, so Sophie, where to find your tax code and consulting HMRC to check if it's correct? I find when I'm doing my tax returns, sometimes it can be incredibly difficult to find the right information. But I think looking at HMRC website, they've probably taken that on board recently, and it's a lot more easier. So do you just want to obviously elaborate a little bit on that?
Yeah, absolutely. I can see why this question's popping up at the minute. A lot of us have received new tax codes coming into this tax year. That's how HMRC likes to do it. And it can sometimes cause you to, if you haven't realised you've got a changing tax code, it can affect the amount of income that you receive. And you might be wondering where you find out if your tax code's changed and where you find out if it's correct. First of all, if you receive an income from ourselves, we take the tax at source. So all you'd need to do is check your payslip. We'll have your most up-to-date tax code on there. If you're not receiving income from ourselves, and you just wanted to check this yourself, you're right, Neil, the government website is a lot better for that now. So you can go on there, enter a few details, have an idea of what your tax code is. But I think importantly, it's if you've got a new tax code or you check your tax code and you're not sure if it's correct, really the only people that can update that is HMRC themselves. So although your pension providers or your employer might be paying, your tax, it is HMRC who notifies them of the code. So if it's incorrect or you've got any questions about it, I know it can be a bit of a pain, but try and get in touch with them and see if they can give you a hand.
Yeah, and it's if they are taking an income maybe from the pension, we issue a pay slip, don't we? So
Absolutely.
They can find that in their inbox, the secure messages?
Just in the documents folder. They store them every month, and you'll be able to see, if you checked back, maybe from your one from April or March, if it's changed, because it'll have the code on there and then the code on your most recent one, and you can see what's changed there.
Great, okay. But if you need any help on that, please give us a call. Great, thank you. Kevin, back to investing. Why do you use multi-asset? Why is diversification so important? I know we talk about the portfolios and diversification on many of our podcasts, because obviously it's our whole mantra on how we invest. But could you just obviously give everybody a bit of an understanding on why diversification is so important when investing people's money?
Sure. So the challenge for if you were just to invest in equity markets is that on average there is a recession somewhere around about every 8 years, and in that recession period, equity markets may fall somewhere between 30 to 50%. Now, if you're only invested in equities, that means your pot of money will fall 30 to 50%. Now, that's obviously a problem if you're close to retirement or about to go into retirement and you want to dip into that pot. So you have been exposed to the lack of diversification. So advanced diversification at True Potential means spreading that money across not just equities but other securities such as fixed income, so bonds which pay a coupon or provide a guaranteed income stream. And then you can go beyond that by diversifying away from the UK, so going spreading the money globally across equities and fixed income. And here at True Potential, with advanced diversification, we spread that across different managers. So we're not exposed to any single manager's bias. Some managers favour growth assets, so that would be things like AI and things like Apple. Some managers favour value, so that would be places like the UK and Europe. And spreading the money across those different pots, different regions, different managers over many cycles should generate a profile of returns which have smaller bumps in the value of those assets than if you just invested purely in equities. And of course you can, depending on which risk profile you and your advisor have discussed, you may find that you have more equities than bonds in your profile, or you may have more bonds than equities. But again, there's an element of diversification in there, looking ahead, given where we are in the cycle. So it should smooth the returns as you grow your pot over the years.
And that's a good point about the risk, depending on what attitude to risk you are. If you're balanced or if you're are more aggressive, you've got a high level of shares or equities within that portfolio. Because typically the equity market is where you get your growth, but can be volatile at times.
Exactly, yes. So I think if you Sir David always pointed out that if you can generate a return of 7%, well, within 10 years of those returns compounded, you will double your money. And that's the sort of return you would get from an aggressive profile looking back. Whereas for the more cautious profiles, you get more security in the income flow and you're less exposed to recession type events where you would have a drawdown in the equity market.
So as an example, maybe if you were a balanced attitude to risk, what would be a split on equities?
So the typical split there would be around about 60%. It may go up to 65 when we're feeling more constructive, and that's where a number of managers are within the True Potential portfolios right now. But that fell down to around about 55%, say, in 2022, when with the inflation shock, managers were rightly more cautious on the outlook for equities.
And the most important thing to take from this is, because these are managed portfolios, when you said we might be 65, we might be 60 from an asset allocation point of view in equities, that's really important, because it's people looking after it.
Yes, it's many degrees of freedom here, actually, because if we take the balanced profile as an example, there are 10 active managers who are looking at the portfolio daily on behalf of our clients. They're not necessarily making changes, but they are looking at it daily. And of course you have Chris Wayland and George Bell here, who are in charge of those managers, and of course make changes month to month between those managers, depending on which manager we think can do well in the current environment. So a lot of degrees of freedom and a lot of governance and insight into what's going on in the
and more
portfolios.
importantly, just looking after people's money.
Exactly, yes. So it's a constant day-to-day. It's not just parked in passive vehicles. It's actively managed by these managers in a variety of securities.
Great. And we often talk about long-term. Clients often wonder what long-term is. What's your understanding, and what's your view on long-term?
Well, I would guess it's when you want to retire is probably your full investment horizon. So that should perhaps be the minimum you want to discuss with your advisor. You certainly, I think, want to look at least one economic cycle, which is around about 8 years. But I would say that most investors should be looking through the entirety of their working life and how they want to grow that pot. So that means taking a constructive view on asset markets.
And when we, just going back to the last question, when we're talking about diversification, you mentioned clients don't want to really see them huge peaks and troughs, but the diversification helps by, smoothing that out.
Yes, I think, now I know a number of clients will quite rightly reflect on what happened in 2022, where we had sort of a 1 in 100 year shock to portfolios because of the inflation shock being compounded by what went on in Ukraine and Russia. But diversification has proven itself over the long run that you can, in a down market, benefit from your allocation to bonds, where you get an income, and when equity markets typically correct through that period, the managers who are managing money on behalf of True Potential can reallocate from bonds to equities, and so that they can manage the swing, and you can benefit from at least one asset class in either an up market or a down market.
So they can change the dynamics.
Exactly.
Of each
actively
portfolio.
Managed and advanced diversification fit very well.
Great. Okay. There was mention recently about the potential abolishment of national insurance, and how much it was worth to the economy, if they were going to increase income tax, potentially if they did. But from a sort of a pension point of view, John, what would happen if they abolished national insurance?
Yeah, so abolishing national insurance altogether is something that the current government has said is a kind of medium to long-term aspiration of theirs. I think it's difficult to call it policy when we're this close to an election, but it's something that they've indicated that they want to move towards. We've obviously seen over the past few months national insurance, the rate that it's charged has come down on a couple of occasions. A couple of % drops on 2 occasions this year. In terms of what that would mean for pensions, there's a couple of ways to look at it. If we talk about people who are retired, we talk about pensioners. People who are taking income out of a pension don't pay national insurance on that income. Once you reach state pension age, you're no longer required to pay national insurance. So in terms of money you're actually taking out of a pension, getting rid of national insurance wouldn't really do much for you. It's just income tax that you pay.
But maybe it's your state
pension.
pension.
Absolutely. Now what national insurance does do is it allows you to build up credits each year towards when you ultimately get your state pension. So at the moment, you'll usually need 35 working years. Is how the rules work now. 35 working years, 35 years of national insurance contributions to get towards that full state pension. Now, if national insurance were to be abolished, I don't think that's the government saying, no one's getting their national insurance credits anymore, none of you are getting a state pension. I think the way that it would likely work would be, everything's getting wrapped up into income tax rather than having income tax over here, national insurance over here, and there will be some mechanism to still get your state pension credit. So I don't think you would necessarily see it impact on the state pension too much. I think that would be a separate policy, but
So
it would change the way that you see your pay slip.
Yeah, it's weird. I was having a look a little bit on the data sources that the government give out, and it said national insurance contributions contribute roughly £168 million, or £billion, I should say, 168 billion. It's very unlikely that they're going to not take that income in some form. So maybe it's an increase in income tax, or potentially.
I think it would make it simpler if there was one single
Band
amount
for
of
everything.
tax. Exactly.
Yeah.
You've got your people say, oh, well, I'm a 20% taxpayer, which is fine. But when you also factor in national insurance, you factor in people who have come out of university, for example, they've got their student loan, the effective tax rate that you're paying on your income is actually a lot higher than 20%.
Yeah.
So I think it would be simpler to wrap it all into one, but it's just, driving that message through to the public to outline the benefits and so on. I think there's another way of looking at it as well in terms of how national insurance affects your pension. Well, you could look at it in the sense that a cut in national insurance delivers more money to your pocket.
Yeah.
If I'm sitting here 12 months ago and I'm paying national insurance at a rate of 10% or whatever it is, and then suddenly it's been cut by 4 percentage points, I've got more money in my pocket.
Yeah.
Could I potentially put that into a pension of my
Yes.
own and accelerate how much I'm going to have in my pension for retirement? So I looked at a few calculations. I think if you take someone earning £25,000 a year, which is a little bit above what the minimum wage is now, for a 40-hour week, the national insurance cut compared to last year, it's saving you about £450 a year. That's money that's going into your take-home pay that wasn't previously.
Yeah.
You put that into an investment. 20 years, you're looking at probably £13,500,
Yeah, it's
depending
a lot
on your
of
growth
money.
rate.
Yeah.
Again, if you're earning more, £35,000 a year, saving potentially £900
Yeah.
a year in national insurance, that could ramp up.
Yeah.
Put it into a pension, you get tax relief on that as well. It starts to really accelerate how much you could save towards
Yeah.
your retirement. So I think there's a couple of
It's important if you
ways to
reinvest
look at
that, isn't it?
Exactly, it's money you didn't have last year. Obviously, inflation exists, the cost of things have gone up. I'm sure many people will want to put that saving towards meeting the day-to-day costs that they have. But if you can find ways of, putting money you didn't have last year into an investment or into your pension for retirement, it'll certainly go a long way.
Yeah, I find it difficult that the government's going to give us some money back, but we'll wait and see. Okay, so moving on to the next question, and I think I'll give this to you, Sophie.
Okay.
How much can I take out of my pension without causing a tax implication this tax year?
Okay, so that one is quite dependent on you and your personal circumstances, but I'll just start off really basic. So John mentioned in one of his queries before about, tax-free cash. So in terms of a personal pension, you tend to have 25% of that available as tax-free cash, as and when you want to take it and how you want to take it, that's up to you. Unless, you may also have, some protection on that as well. So if you do think you have some tax-free cash protection, I'd definitely encourage you to speak with your advisor. But as a standard, 25% tax-free. The rest of that, as and when you take it, is all based around, your tax band, your personal allowance. So usually it's your $12,570 a year that you can take as income, and not have an implication. So you could take that with a mixture of tax-free cash. But for this one, I would say definitely speak with your advisor, because I know you mentioned earlier, Neil, you might have income sources coming from elsewhere, whether that be employment or a state pension or things like that, that could already take up some of your personal allowance and then could push you into, being taxed and having an implication on that withdrawal.
Yep.
So there are ways and means of how you look at it to get the best mix, taking some tax-free cash with income.
Yeah.
But I think that's what their advisors are here for, to really get the most out of your money.
Yeah, and to minimise the tax. So very good advice there if you need to speak to anybody about it. If you're unsure about your income and your tax requirements, then, we will have a look at that for you. So just give us a call and book an appointment with one of our advisors. Thank you, Sophie. Okay, I think this question was dedicated to Kevin, but it's probably more of an advice one, so I'm going to take this one. Is it worth switching portfolios to a higher risk? And if so, how this has been done? So you can switch to a higher portfolio if you want to. However, switching to a higher risk doesn't necessarily mean that you're going to get a better return because of market conditions. And risk is very personal. So I would say please speak with an advisor on that point. Risk is a very serious subject when it comes to investing. And as Kevin alluded to before, there are certain investments within that portfolio that may not suit your attitude to risk. So Kevin talked about higher equities or shares within the more higher risk portfolios. And there is, in general, in most cases, a lot more volatility that comes with that. So if you've got more of an allocation of shares within your portfolio, it could be 80-90% of equities within a higher risk, then that may not suit you and it may not suit your attitude to risk. How do you measure your attitude to risk? Well, we can do that for you. There are various ways of doing it, about talking about your capacity for loss, and about your long-term investing and how much required growth that you want. So not an easy question, and not one which we could probably say as a single sentence to complete on a podcast, because it is quite an in-depth survey. And myself and John, being financial advisors, have always recommended that you speak to an advisor and go down the advice route. So give us a call and book in an appointment. Okay. So, final question before we wrap things up. I know there's been a lot of work done by True Potential to contact beneficiaries when accessing investments. So, how do you make sure, John, that your beneficiaries can access your investments when you're not here anymore?
Yeah, so in terms of your beneficiaries getting access to your investments after you're no longer here, it depends on the type of product you hold, the type of investment you have. You might have an ISA, you might have a pension, you might have a general investment account. Now, the way that pensions work, you're allowed to name beneficiaries on that account. Essentially what that allows our pension trustees to do is to look at what we call your expression of wish. We'll look at who you've named to receive your pension after you pass away, and the trustees can then contact those beneficiaries to pay the money out to them in the way that they wish to be paid. Now, they can choose to take that money and have it paid into their bank account. Tax implications of that depend on how old you are when you come to pass away, or equally, something that many beneficiaries choose to do is just to keep it inside that pension environment. If it's invested, it can remain invested. It could be invested in line with the level of risk you're most comfortable with, or your beneficiaries are most comfortable with. And then when your beneficiaries eventually need to take an income out of the pension, they've got that there for them when they need to use it. Equally, pensions are almost infinite these days. If I leave it to my beneficiaries and they don't use it, they can then pass it on as a pension to their beneficiaries, and so on and so forth. So pensions, the idea is that you would name your beneficiaries and then they would be passed directly to who you've nominated. Now, ISAs and GIAs are slightly different. They tend to be controlled by what you've written in your will. So if you've been to see a solicitor or a will writer and you've drawn up a will, I think the key takeaway is to make sure that you've included your wider investments in that will, so that when your executors come to deal with your estate, it's clearly signposted who you intended to leave your ISAs and your general investment accounts to, and other investment accounts as well.
And I think we've just recently done, Sophie, a lot of work from a beneficiary point of view, and it can be easily done via the client side.
Absolutely. So you can update your expression of wish for your pension on your client site really easily. If you do need a hand with that, just get in touch. But yeah, we really pride ourselves on providing a really good beneficiary service. You've trusted us with your life savings, which you're now passing on to your beneficiaries, and we'll be here to support them, be that with advice on, how is best for them to utilise the funds and things going forward. But yeah, just really make sure you do complete that section, because it gives us all the information that we need to help your beneficiaries when they need us the most.
And I think it's a big education piece on, especially pensions, John, when a lot of people, when they think when somebody passes away, that pension fund has to just be taken as a lump sum or income, whereas realistically what you're saying is it can be kept within that pension wrapper and used very tax efficiently in line with any other income that you've got. Yeah,
exactly right. I think, if someone leaves you a pension, money gets just sort of deposited into your bank account. Well, it's then a question of what do I do with it? Do I invest it? Do I put it into a savings account? Am I going to have to pay tax on any interest that I generate? Well, the solution's kind of almost already there for you. You can leave it in the pension until you actually need to spend it.
Yeah.
It's in a position to grow tax efficiently. Pensions don't pay income tax internally. When they grow, they don't pay capital gains tax. So pensions are almost in the ideal spot for beneficiaries to receive them. It's just a case of education, as you say, and drawing on it as and when your beneficiaries need it.
Great. Okay. Well, I think we'll wrap it up for today. Thank you to everybody for watching. Please like and subscribe. I hope you got everything out of the May Q&A special. If you don't, please email in and we can answer any other questions that you have. But once again, thanks, and we hope to see you soon.